Selling options is the closest thing to printing money. It's like a dividend on steroids. And while it does print money, it can also put you underwater very, very quickly, especially with massive downturns like we had over the last 10 days. We're down over double digits in just 10 days and over 20% year to date at the time of making these plays. That's a market correction and technically a bear market. Folks, I want to be as transparent as possible with you and show you how I print money, but also how I manage massive underwater positions in times like these. For this reason, I'll be showing you a mini series on how I'm managing a $1 million marker on 3 different stocks, and I'm massively underwater. The stocks are Sofi, Robinhood, and MSTU. If you're unfamiliar with MSTU, it's a leveraged fund on MSTR, aka a Bitcoin play. I'll do this over the course of today, tomorrow, and the day after tomorrow in this little mini series. I'll do it on different days, starting with SoFi today, Hood tomorrow, and MSTU the day after. I have a massive $655,200 collateral marker on SoFi, $140,000 200 on Hood, and $255,100 on MSTU. That's north of $1 million that I'm managing successfully thus far in the worst of times over the last 3 months. And since I'm literally nobody to you and you're asking who is this phony talking to us, let me show you some receipts. On SoFi, I've got 468 contracts at 100 shares per contract at a $14 strike. That's $655,200. On Robinhood, I have 26 contracts at a $37 strike. That's $96,200. And another 10 contracts on Robinhood with a $44 strike. That's another $44,000 for a total of $140,200. On MSTU, I've got 200 contracts with a $2.50 strike, another 200 contracts with a $3.50 strike, and a much bigger 193 contracts at a $7 strike for a total of $255,000 and 100. We're playing with real money, big money, and my goal is to show you what I've learned doing this professionally. The point of this is not to flex, but to show you real world examples using real money in real, non-cherry picked times like most people do on YouTube. This video is going to be filled with a ton of information. Just follow the screens and the arrows. The reason I'm breaking it down into a 3-part mini-series is because each trade is absolutely unique with its own different circumstances to give you the most real-world experience that I can give you. It will be on a playlist below called Managing Underwater Options. So make sure you watch all 3 episodes of this mini series. If you're new here, my name is Adam, and I retired in 2024 at the age of 41 years old. My retirement is built on a 3-part approach. Number 1, the multi-bagger for asset growth. Number 2, high dividend income for consistent cash flows to pay your bills. And number 3, options income to supercharge your passive income with covered calls and cash secured puts. I'm not a financial advisor. This is not advice, just me walking you through how I manage real world trades with real money. Full transparency and no fluff. Today we're diving deep into my SoFi options, $655,000 in collateral, and it's underwater big time. The markets have been absolutely a slaughterhouse, down over 10% in the last 2 weeks and over 20% year to date when I made these plays. We're in a correction and technically a bear market, and SoFi's been absolutely hammered like a nail on a construction site, dropping to lows of $8 last week. Most people would panic, cry, and call them mamas, but I'm Cool as a cucumber. Why? Because I've got a playbook, rolling and wheeling to turn this disaster into a win and a money making opportunity. I'm going to break it down with a beefy lesson, real world examples from my trades, and peek at what's next. Follow the screenshots and arrows on the screen. This is loaded with information. Let's kick off with the basics for beginners because I know a bear market sounds terrifying when you sell a cash secured put. You're agreeing to buy a stock at a set price, the strike price, by a certain date. You get paid a premium up front, like a dividend on steroids. If the stock stays above your strike, the contract expires worthless and you pocket the cash. But if it crashes below the strike price, like Sofi is doing in this bear market, you're absolutely underwater. This means you might have to buy the shares at a price higher than the market's giving, or you've got to manage the position to avoid that hit. Here's the good stuff. You've got two killer tools, rolling and wheeling. Rolling means closing your current contract and opening up a new contract, usually a month out, ideally for a net premium. It's like hitting the snooze on your trade. You buy time for the stock to recover while stacking more cash. Wheeling kicks in if you gotta sign the shares, meaning you absolutely have to buy them. Instead of freaking out and calling your mama 2 times on the same day, you sell covered calls against those shares, raking in even more premium. Then you go back to puts, then calls again, round and round we go, like a money making wheel. It's extremely important to understand these can get assigned at any point, even next week, a month early. Since I'm in the money, that means that the current strike price is above the share price currently on open market. It's the buyer's choice, but from my personal experience, people are greedy and will usually wait until the last few days of the expiration week. So make sure that you know the risks and manage them properly. The secret weapon here is your actual cost basis. This is absolutely massive and huge, and it's imperative that you understand what your cost basis is. Your cost basis is not the strike price. It's the strike price minus all of the premiums that you have collected cumulatively. Every roll, every wheel shaves down what you'd really pay if you have to buy the shares. In a bear market like this, that's an absolute lifesaver. It keeps you calm because you're not losing what it looks like on paper. Now, why does rolling shine in a correction? The bear market's got everybody spooked, spiking implied volatility. Higher volatility means a fatter premium for selling your puts, especially when stocks like Sofi are absolutely bleeding out. But you've got to move fast. If the stock's too far below your strike, say 30% or more, premiums vanish and you're stuck. Ideally, you want to roll when it's within 15 to 20% of your strike. That's the sweet spot for a decent premium. You'll probably be collecting around 50 or 60% of your initial option sell. In a perfect scenario, you want to be somewhere between 5 and 10% range, and you'll be rolling for nearly the same premium as your initial play. If you're under 5%, that's the dream, and you'll be getting more premium than you originally got when you first opened up the play. Ideally, you don't want to go outside of the 20% strike, but you can't absolutely control flash crashes. Here's the kicker. You can still roll the positions out because in times of flash crashes, the implied volatility spikes and the premiums absolutely jump, allowing you to roll and live to fight another day. Markets don't just chop in bear markets. You have times of bullish rebounds, and in bull markets, you have times of bearish drops. As an option seller, you know this, and these times are perfect to roll out or get out of a position. Similar to what just happened to me, taking advantage of a bounce to roll. I do think we reached lows, but this is just my guess. I can't know anything for sure. So don't be greedy and make sure that you're managing your positions. It can be absolutely scary if you're underwater. So just breathe, stay calm, drink some water, and pay attention as I'm living proof showing you that it's possible to roll even in some nasty bad times. This correction is absolutely rough, but history shows the US trends up long term. Rolling lets you ride out the storm, collect cash, and bet on the bounce. Let's dig into my $655,000 SoFi Monster. If you're not looking at the screen now is a good time to start and watch the arrows to follow along and understand what's going on. This can save your trade one day if you find yourself underwater. I'm showing it all. Follow the screenshots and the arrows. On February 6th, I opened up 80 cash secured puts with a $13 strike expiring March 21st, grabbing $3,040, about 38 cents per contract. February 20th, I went hard, 200 cash secured puts, $14 strike expiring March 31st, pulling in $9,600, about 48 cents per contract. February 21st, I decided to open another 200, same strike, same expiration, another $9,600. I rolled those 80 contracts from $13 to $14 to zinc up, netting another $1,840 or 23 cents a contract. Across 480 contracts, I banked $24,080 in premiums. 12 contracts got assigned early, so I sold cover calls on those 1,200 shares for $360 or 30 cents per contract. That's wheeling. But I'll skip the details today to stay focused. I'm left with 468 current contracts with a $14 strike and $655,000 and 200 on collateral. 468 contracts times 100 shares per contract times $14 gets you that $655K. When I opened these, SoFi was cruising at right around high 14s, low 15s, safe strikes, fat premiums, life was good at the time. Then March 19th hit, SoFi fell to a high of 12s, underwater as the market started cracking. I rolled all 468 contracts to April 17th, $14 strike, collecting $11,675 or 25 cents per contract. Total premiums, about 75 cents per contract. 50 cents was the initial, rounded up, plus 25 cents for the roll. Banking 75 cents. So my actual cost basis is $14 minus 75 cents gives you $13.25. That's how much I would be paying for the shares, even though I would be buying them for $14. I was underwater, but my real exposure was way less than $14. Fast forward to April 7th and April 8th of last week. The markets are absolutely in a death spiral. Everybody is losing their minds and everybody is getting absolutely worried. SoFi tanked to a low of $8, a whopping 43% below my $14 strike price. Most people would lose it, but I stayed chill knowing I could manage this. Normally, I wait till the last week before expiration, April 14th for April 17th, when these were expiring. But with SoFi at $8, I had to act absolutely fast or risk zero premiums or maybe even a debit on this roll. If it stayed that low, I'd be staring down assignment at $14 with no offset, which is absolutely ugly. So I jumped in early, cool-headed, and ready to manage these positions a week earlier than I normally would. April 7th at noon, I tried rolling all 468 contracts to May 16th, 1 month out, as per usual, for 25 cents per contract. No go, no fill, no buyers. The market was an absolute mess. It was in shambles. Every single tweet sent the market up or down, depending on what Trump said. April 8th, SoFi rebounded a little bit, stuck around that $10 mark, and I'm way outside my 20% comfort strike window. I needed a slight bump to grab any premium. At 9:31 a.m., I bid 30 cents. Nope. At 10 a.m., 20 cents. Nada. At 10:37 a.m., 15 cents. Still nothing. By 11:19 a.m., I just wanted to get out of the play and live to fight another day. SoFi nudged above $10, like $10.15. I saw my shot. I dropped to 10 cents. Bam, it filled. I rolled 468 contracts to May 16th, same $14 strike, and grabbing $4,680 or 10 cents per contract. Here's the deal. Total premiums currently collected, 50 cents my initials rounded, 25 cents in my March roll, and 10 cents for April roll. Now it is April, but this ain't no April Fools. That's 85 cents per contract. So my actual cost basis would be, if I had to buy the shares, $14 minus 85 cents, bringing my now price to $13.15. And if anybody's doing the math, that's actually a 6% return on the $655,000 collateral. If you take 85 cents and divide it by $14, you get that 6%. Hitting my 2% monthly goal despite being in a bear market bloodbath. Sofi is around $10, miles below $13.50, but I've got till May 16th. If it climbs above $14, the contracts expire worthless, and I keep $40,000, $735 in premiums. That's $24,080 plus $11,675 plus the current $4,680. If it's above $13.15, I'm even, Steven, or winning, and I'll reevaluate. If not, I'll roll again or wheel. Now, why does this work and what's next? This bear market, flash crash, correction, whatever you want to call it, is absolutely vicious, but I'm still stacking premiums. Rolling's my absolute lifeline and the lifeline of many option sellers. It buys time, cuts my cost basis, and bets on a rebound. Sofi's a fintech giant. I'd own it in a heartbeat if assigned. I'd get 46,800 shares at an effective $13.15. Not $14 strike. I'd sell covered calls, kick off the wheel, and keep the cash coming. But my goal is either to keep all the premiums or buy low and profit when Sofi recovers. Worst case, I hold the stock I believe in at a steal. But I think I'll be good with expiring these contracts worthless. Say May 16th hits and it's expiration day, and Sofi is at $9. I'll still be underwater. I'd roll to June 20th, a month out, at $14 strike, aim for around 10 or 15 cents per contract, collecting roughly 6 or 7 grand more. My cost base drops to $13. I've rolled trade a year straight. Some months are flat, others banking big money. The market's up long term, Sofi got legs, and time is my ally. Beginners, don't sweat collateral. My $655,000 is just backing my promise to buy if assigned. If I buy the 46,800 shares at $14, premiums means I'm paying $13.15, which is a game changer because it's not the $14 you promised to buy it at. Pick stocks you know cold, like Sofi, and start smart. Go for a 20 delta, 80% in your favor, 2% monthly premiums, 4 to 6 weeks out. And that's how you keep cool in bear markets. No panic needed. Wrapping up, this $655,000 trade's an absolute beast, but I'm steady because I've walked this road before. A correction like this is where strategies get tested. Volatility fuels premium, and rolling lets me capitalize while waiting for the turn. I'm not hoping for luck, I'm crafting a win, one premium at a time, whether you're retired like me grinding 9 to 5 or chasing a goal, this can work. Start small, one contract on a stock you hold forever, and build from there. If I can do this, you can do it too. I'm not a financial advisor, this is not advice. Please don't take this as advice and definitely seek professional help. The only advice that I could give you is click on this video right here if you want to learn more about covered called ETFs and you don't want to sell your own options. Thank you so much. Peace.